Look, I think it's the question that everyone's asking at the moment, but I think the reality is we call this a new normal. I think the reality of the last 5 years is that we've been investing in a very abnormal market. So I have a slight sort of philosophical question as to whether, what is the steady state. I think, look, we're coming out of a very extended bull market. I think that if you look at the conditions in 2021, there was a lot of overheating. There was a lot of companies which raised probably more capital than they needed to, which caused, operational challenges. It distorted the funding timelines. So in a way, I think that not to be, overly optimistic as a seed investor now, I think that a lot of the correction that we saw was actually very healthy for the market. So for me and our fund, we've always been very focused on the very earliest stage. And for us, we think that this is a much healthier market to be building in. So for us, we've continued to do what we're doing and trying to still work with the very best founders at the pre-seed and seed stage.
I totally agree with Pippa. There were some stats out the other day that the top 5 global venture firms, they did 1,000 deals in 2021. Mm-hmm. They did 700 deals in 2022. And they're looking to do around 300-400 this year. They're on track to, that's what they're on track to do, which feels like a catastrophic jump down, and it's terrible for the market. But actually, that's just the same as what it was in 2017, 2018, 2019. That is kind of just the average. So I agree with Pippa that we've been in abnormal times, and we're getting more towards normal times. In terms of how it's changed for us at a fund, yeah, we do think that it's a better environment for investing at the early stage. The only caveat is what we're advising our entrepreneurs and our founders is different, because it is taking longer to raise follow-on capital, which is really important. The median time now for raising a Series A is 25 months, which is absolutely brutal, because you normally tell your founders to raise for an 18 to 24-month time horizon. So that's getting really pushed out. The Series A market is horrible. So how we're advising our founders has really shifted.
Well, I think apart from just the funding landscape and the valuation landscape that's changed, and I think we've all lived through that over the last couple of years, and we've been telling our founders to really think about cash preservation. So I think all of us in this audience know all of that stuff. When I look out, though, I still don't think we've hit the new normal. I think there's another wave of interesting developments that's going to happen, namely inorganic growth. I've just come from a breakfast this morning talking about there's 1,700 AI startups in the UK alone. They're not all going to survive. There's going to be plenty of opportunities for founders who did raise good levels of capital, either now or in the recent past, to snap up opportunities to inorganically grow. We've been in a world where everyone's wanted to build on their own, do it their way. We'll build it better than the person next to me. Where if the person next to me is not doing quite so good, then it's time to think about market consolidation, even at the Series A stage. And so I'm seeing it already, the emergence of inorganic opportunities to consolidate. And I think we're going to go through that wave over the next 12 to 18 months, and then we're going to come out the other side in a much more sustainable way, which I think will be good for everybody.
Well, it was obviously a big shock. It was obviously a big shock to the industry. It was a big shock to everyone. I think HSP Innovation is doing really well. My impression is that people are very happy with their service, and they think it's secure. But I think it was a wake-up call for the industry to really think about really boring stuff like treasury management, which no one was really bothered about before, and they had all their money. They had their $5 million seed round in their Monzo account, and it maybe wasn't the best idea. I mean, the funny thing was it led to this 4-month period of just absolute VC insanity about treasury management software. Hundreds of pitches, and every single venture fund, went into a treasury management software, because I think people saw this and they were, oh, this is important.
I can just speak as a client, I suppose, but we've only had about a month, I think, since the transition. I think that what SVB stood for was innovation and working with startups at the most sort of granular level. And I think, I can only admire HSBC's determination to replicate that in some way. It's too early to really know how the platform's going to roll out, but yeah, look, I thought about wearing my SVB t-shirt today and thought that would be a bit on the nose, but so far so good.
I think, I think for those of us who were working in 2008 during the financial crisis, I think we learned a lot during that process of having all your eggs in one basket. And that really came home to roost earlier on this year. Saying all of that, I'd say in Europe, the SVB event was much less impactful than it was in the US. The diversification of founders and banking across the European champions wasn't centered on one item, but it obviously did raise, a big issue when it comes to how CFOs professionalize. And I think a lot of startups probably didn't have a professional CFO, and probably neither should they, to the point that you've got treasury management systems. No, actually, all you need is a spreadsheet and a conversation with your board. Like, would all of you put all of your life savings with one savings account? No, you wouldn't. You'd spread it around. So I think there's a little bit of over-egging that's happened. But what I would say, as we've come out the other side, I think SVB have come out and in their new guise as HSBC, and are really trying to push the envelope with the new balance sheet that they've got, which I think makes a much more competitive proposition versus all the other venture debt providers that are out there. Saying all of that, what I am seeing today versus 2 years ago is a massive spread in what venture debt providers are offering in terms of term sheets for startups. And I think we're still in this environment where you really have to shop around and work hard to get good terms, because the terms are so wide, whereas 2 years ago, the terms were incredibly narrow between all the different providers. We all want an IPO, right? You'd have read the FT article this morning, many of you, probably about Arm, right? So if any of us can help Arm be successful and then Instacart be successful, then I think that's good for everybody. It's good for whether or not it's a US listing or a European listing, I don't think it really matters at this point. It's all about getting the capital markets moving again. Arm, hopefully, they're adjusting their valuation down a little bit. They're the upper end of the adjusted lower bound. So let's keep in proportion. It's not like everything is going gangbusters. But absolutely, we want Arm to be successful. We want Instacart to be successful. If there's a slight pop, let's not ridicule it. If there's a 5 or 10% increase because they're oversubscribed, that's great. That money will then start being returned to the big endowments, the big insurance companies, the big pension funds, the big asset allocators in the US and elsewhere. They will then start reallocating that back into other VCs, and then money starts freeing up again. We need that to happen.
I honestly try not to think about the IPO market, is the truth. Because as a seed investor, it is astronomically difficult to know where the IPO market's going to be in like 8 years' time, where what you're when what you're doing is going to IPO. So I don't think about that much. But what I would say is that a lot of our founders, particularly in France, and I do a lot of French coverage, but they all want to go to the US. They all want to go as quickly as possible to the US, and that's partly because it's a big market, et cetera, and it's a big prize. But it's also partly because they know that ultimately there is an exit for them there in the US, and there is that capital there in the US. So it's obviously important.
I think just to quickly piggyback on the IPO sentiment question, because I think I have a different view to Michael, which is that I'm a seed investor, but I do unfortunately pay attention to the IPO market, and that's partly because maybe I started out working in public markets, but I do feel like there is a trickle-down sentiment, and I think if we look at hopefully Arm being 10x oversubscribed now, probably going to be the largest IPO since Rivian was around 13.7 billion, I think, in November. And then hopefully, I think Instacart came out yesterday looking like it's going to raise maybe about 9.7. So even though, yes, I agree, like the timelines from when the companies I'm investing in to IPO are extremely long if they're going to happen at all, the reality is that we are looking at the pace of subsequent funding rounds. And that, once you get to sort of Series A, Series B, does begin to get impacted by sentiment around the pre-IPO growth, IPO stage. With regards to, the question was whether the US is a harder market. I think it's very hard to give one answer depending on, multiple sectors. I think the reality is the US has always been an attractive market because, as you said, it's the largest market out there. That said, I think depending on the sector you're in, hiring can be a lot more expensive. The cost of capital can be more expensive. So it's hard for me to give a one single answer.
Any investment bank is going to have to do a very strong book building process, right? Their job, why they're getting paid, is to make sure that the level of funding that you want to generate as part of these IPOs can be met. Arm are trying to get $5 billion from this IPO. Instacart are trying to get somewhere between $600 and $700 million from this IPO. So you've got to have the book has to be very strong. So I think one of the things that I want to see, talk about everyone going to the US, because there's really good cornerstone investors in the US. So one of the questions over the next 8 years, when hopefully some of your seed investments do IPO, is like, why won't they be in Europe? One of the things that Europe has to do better off is cornerstoning our own IPOs. We need the pension funds, the insurance funds, the endowment funds, the hedge funds to be excited about European IPOs and European companies so that the investment banks can build a strong book here in Europe. So some of that comes from ensuring that those same people who will invest at the IPO are investing pre-IPO. In the US, pension funds and investment funds and insurance funds invest in VCs, and those VCs invest in startups. In Europe right now, pension and insurance funds cannot invest in VCs easily. The UK has just made a big swing this year. There was Mansion House, kind of the big summit in the Mansion House earlier this summer. The big insurance companies and pension funds can now start investing. That's going to take time, and that's going to start bringing the muscle into the ecosystem where these big managers of money will be interested in Series C and Series D companies because they've already invested in them and they're ready to help them cornerstone them for IPO. So there's a lot to play for here. I think there's a big misnomer that this pension fund going away suddenly is going to allow billions to flow into the UK economy. It is not. We're many years away from that because the pension funds are not set up today to deploy the capital they want to. They want to. The will is there, but it's going to take time. And then the trustees of, the Peckham Teachers Pension Fund and the Northern, Royal Mail Pension Fund, they're going to have to get comfortable with investing some of their money of their employees into private assets. It's a new asset class. It's going to take time.
Look, I think a big part of being an early stage investor is being inherently bullish. You're investing in an asset class where, the distribution curve of your successes is always going to be skewed to, a very few that succeed. So inherently, I'm going to be bullish. That said, I think if you actually look at some of the numbers, I think late stage, let's call it pre-IPO funding, is down around 64% as of Q2 year on year. Early stage, let's call that Series A, was down around 30%. Seed stage is flat. And if you consider where we were in 2022, sure, that had corrected somewhat from 2022. So sure that had come down from some of the lofty highs of 21, but as we said earlier, I think that's a good thing. So, one, inherently, I think, as an asset class, I am an optimist and I will continue to be investing in the earliest stages of companies, but I think that if you actually look at the sentiment in the market, and perhaps it makes sense because of the risk reward and the amounts of capital being deployed if you're doing a pre-seed versus doing a pre-IPO, then you're actually looking at the most supportive market for that right now.
Yeah, I mean, as we said, the seed market is still pretty hot. It feels competitive. The deals are competitive, and I think it'll remain that way. But I think the Series A market and the Series B market is really turned off. And as I said in the beginning, that makes a massive difference to how we think about investing at seed, because ultimately you can back the best company in the whole world, but if they die in 18 months because they can't raise, then what's the point? I would also say that some bits of the seed market are, as frothy and bubbly as they've ever been. We were talking about generative AI, and it's where I'm spending almost all my time, and I'm really excited about it, and it's what gets me out of bed in the morning with a spring in my step. But, if you look to the last YC batch, these 4-week-old companies are, trading away at 30, 35 million post with, not that much to show for it. And, maybe that's a cause for concern. We do a lot of climate. I mean, that is another sector that has been relatively protected from this downturn, along with everything AI. And then I guess, this is kind of AI, but we do a lot. We have a thesis that over the next 10 years, a lot of software companies will be replaced by something with a kind of AI, generative AI flavor. And I wouldn't really call them AI companies, or I wouldn't even really think of ourselves doing that as being pioneering AI investors. But I think there'll be a generation of companies that come with that flavor that is going to be really exciting over the next decade. And I think a lot of the Series A, Series B funds share a similar view about what can happen in B2B SaaS. So I think that's an interesting area as well.
Growth stage right now is ugly. It is awful. So let's be honest about it, right? I could sit here and pump it up, but it's really tough out there right now if you're looking to do a Series B and Series C. And so some of that comes from the new pretenders. A few years ago, we talked about software's eating the world. Then you've got software eating software, and now you've got the next generation of companies that were only born 3-4 years ago, 5 years ago, being eaten by companies that were only born 12 months ago, 18 months ago. And so people are concerned about, is this company that's now got to Series A trying to raise a good Series B, or Series B going to get Series C, are they going to get overtaken by the new pretenders that are popping up left, right, and center? So there's a bit of nervousness there. The other thing that is you have to look beyond as an investor at the more growth stage, and we've got an early fund and a growth fund, so we get to see both, is the memory muscle that analysts and our team used to look at predominantly over the last few years is bottom left to top right. Let's just extrapolate the last year of growth over the next 4 years, and now we can come up with a multiple that somehow we justify to our ICs, and everyone's happy. The problem is nearly every company in the portfolio has reduced headcount in the last 2 years. Nearly every company in the portfolio has missed revenue in the last 2 years. And so now you can't extrapolate 4 quarters of historical data and pull it forward for the next 3 years. You're having to really think about, well, the company was doing this, then maybe they went flat, or maybe they went down, they've adjusted their go-to-market motion, they've come back out again, they're in the new normal, but is that sustainable? Now they've only got a quarter of two's worth of traction. Do I have the confidence to extract that and move that forward? And that is not something the VC market has been very good at doing in the past, because everyone is invested in these high growth, highly scalable businesses where it's actually quite easy to shove it into a spreadsheet and figure out what the multiple should be compared to comps in the US. So you have to do a lot more work now, which means people are slowing down the investment timeline, and it also means the founders can't just walk into a VC and expect to get cash the next day. The whole thing has slowed down. It's a lot more work for everybody. So I think the topic of kind of European critical infrastructure, if you're a startup founder and you're building something that's inherently European, you are at a political advantage versus your US compatriot trying to sell into the European market and build a European base. So that's the first thing to kind of state, and I can't emphasize that enough. With the European AI Act, and I met with Dragos earlier last week, we can't ignore it. We're the UK right now, we're on the side, but you have to see what's happening with the European AI Act. Taking all that to one side, we can talk about AI till we're blue in the face, but there's other critical infrastructures, cloud, space, compute, you can keep on going. And we saw this only in the news on Friday night. When you think about where we've been in the last 2 years with the situation in Ukraine, you've had a South African founder with a North American company providing internet to Europe, right? He publicly said last weekend he turned off the internet above Crimea. So we did not have, as Europeans, any solution to that. I think that's highly embarrassing. And so all of us, we need to make sure there are alternatives to the US default. And that creates opportunities for investors, and it creates opportunities for founders to get some unfair advantage where the power base has typically been with the cartels in the US and perhaps in Asia. Well, I think, if you want to expand quickly, the US is a great market to go to. If you want to expand slowly but sustainably, then the European market is a good market to continue to really double down on.
I just think that at the moment there has never been a better time to build solutions to very difficult problems. I mean, I think that one of the problems that Stephen just explained is it's just one of the areas where I'm seeing a lot of innovation right now. So in the last few years, we've had such a boon in B2B SaaS, consumer, social. I'm so excited to be spending my time on infrastructure, cyber, sure AI is part of that, and then more sort of frontier deep tech sectors. So I think for me, a lot of the themes that we've just been talking about have meant that VCs are more open than ever to really backing, again, really hard problems. Throw bio in there as well. I think that people are looking at that again. And so, I suppose I've had a bit of a sector rotation personally and where I'm spending my time, but I think that that's because a lot of the problems we're now thinking about are very, very front of mind in a way that they probably weren't when we were all investing in B2B SaaS 3 years ago.
We're doing a lot of work. So we backed Mistral. We're a very small ticket in Mistral. The deal which Lightspeed led, building an OpenAI competitor. And the mission, the idea of Mistral was to create a European rival, and it was kind of backed by the French government or quasi backed by the French government. And for us, that was really compelling that Europe can build these champions. I'm an angel investor in ESAR, which I think is a Lakestar investment. I think there's definitely a path forward in creating the European sovereign version of stuff, but it's often not as shiny as the kind of classic VC place, and requires a bit more thought, a bit more networks, a bit more helping, a bit more touchy-feely stuff. So it's a bit more complex, but I think it's exciting.
So not to just reiterate what I said just now about solving really hard problems, but I think for me right now, sure, I divide into two camps. One, I'm looking to back people who are extremely ambitious, as I always am, but in some of these sectors that probably we've seen a bit of a sector rotation into. So sure, that's AI, but that's also some more frontier stuff. So whether it be infrastructure, whether it be robotics, whether it be infrastructure, cyber. So I'm looking to really, during I suppose this, less inflated market, looking at people who are really looking to go back to basics and build really intricate solutions and smart solutions to very hard problems. I think that the second bucket that I would say is that you've got to have your toolkit, knowing that the sort of atmosphere you're raising in now relative to the last 2 years is very different. So be really clear on your path to profitability, revenue, and realistically at the pre-seed stage or seed stage, you're not going to be profitable or have a lot of revenue to show for, but make sure you've got scalable unit economics and you've already thought through your business model in a way that's going to make sense to that investor. And then obviously you want to be mindful about things like runway and be very careful around leaving enough time to raise that next round.
I think that it's worth remembering this is still just a hilariously good time to be starting a business. And it was the point that Pippa and I made at the beginning, that maybe it's not quite as good as 2022, where you can turn up with a deck and a dream and get handed millions of dollars, but it's still in global history just an amazing time where people will give you a huge amount of money for transformational people trying to do transformational things. And I think particularly when you have these technological unlocks, like LLMs, but there are lots that are happening just all the time. There are these unlocks happening, which making businesses possible now that weren't possible even 6 months ago or a year ago. It's just extraordinary. It's an extraordinarily good time to be starting stuff.
Before you take money from a VC, go for dinner with them. whether it's Pippa or
free
Michael
dinner.
or myself, you are going to be married to this investor for a bloody long time. You're going to want to call this investor up at 4 p.m. on a Sunday afternoon and interrupt their Sunday roast with some anxieties that you've got about a sales meeting the next day. If you don't get on, it ain't going to work. And if there's one thing the last couple of years has shown, don't just take the cash, you're taking the advice and the counsel. So go for dinner. Do you like the person? If so, sign the term sheet.
Thank you so much, everybody. Thank you. Please do sit for just a second. I know that people are really fascinated, and there have already been questions about whether you can take some questions at the back. So hopefully you folks have got a couple of minutes where you can hang with the audience. If not, we understand. But there has been a request, so hopefully you can take some questions. People have been doing some frantic note-taking, so you've either inspired everybody about the future or everybody is frankly terrified. Who's to say? Thank you so much to Pippa, Michael, Stephen. I knew. I was just gazing into your eyes. I was just looking at you. And Russ, thank you so much for a really inspiring session. Big round of applause, everybody.